Okay, so in the first tutorial we're going to talk about call options, which are one of the most basic types of options, vanilla options they're called, that you can get. You have calls and you have puts. So we're going to talk about calls. But before we talk about calls, we need to first understand what it's like when you just own a stock and the kind of payoff that goes along with that. So this diagram shows we've got the P&L up here, so your profit and loss is along this axis, and the stock price is along the horizontal axis. And if I was to buy a stock, let's say at a price of 100, then my payoff would look like this line. So if the stock went from 100 to 110, then I would make money, I'd make 10. And if the stock went down to 90, then I would lose money. So I buy the stock at 100, it goes to 110, I make a profit of 10. And if the stock goes from 100 to 90, then I would lose 10. Now that's what you call a linear payoff, okay? Or a delta 1 payoff. Now what delta 1 means? Delta is basically the slope of this line, yeah? If you look at it, for every 10 we go that way, we go 10 that way. So the slope of that line is 10 divided by 10, which is 1. So that's delta 1. And we'll talk more about delta when we talk more about options. So when you buy a stock, you have a delta 1 payoff or a linear payoff. Now what options allow you to do is to have a non-linear payoff. So a call option allows you to have a non-linear payoff, so this downside part gets taken away. Why is that? Because a call is the right to buy a stock, but not the obligation. So whereas before you bought the stock at 100, that's it, you bought it at 100. So if it goes down in value, you will lose money. If it goes up in value, you will make money. But when you have an option to buy a stock at 100, you make money if it goes above 100 because you do then exercise that option and you buy that stock at 100. But if the stock goes down, because you've only got the right but not the obligation to buy it, you don't lose anything. So your P&L stays along that horizontal line. So anywhere below 100, you stay in that horizontal area and you lose nothing. And anywhere above, you make the same amount you would make if you were long the stock. Now that obviously sounds fantastic and that sounds great, and it is, but that's just the payoff of a call option. It's not actually your true P&L. Your true P&L has to include something called a premium. Because to have this payoff, you have to spend a bit of money, which is the premium of the call option, right? So the true P&L, if I was to draw it, would actually drop, let's assume we paid 5 for this call option. So then this whole payoff drops by 5. And that minus 5 is there. So anywhere below 100, and 100 is called the strike price, yeah? Anywhere below 100, you would have spent your 5 premium and you would have made nothing back. And for you to actually make real P&L, the stock would have to rally or go up to at least 105 to this point for you to have made back the premium that you spent, and that's called the break-even point. 105 is called the break-even. And then once it's gone above that break-even, that's when you'll actually start to make money, right? So a call option is a bullish position. If you buy a call option, you spend premium and you want the stock to go up, but it needs to go up by at least strike plus whatever you paid for the option before you start making money. It has to get above your break-even point. So that's how call options work. Now, what is the most popular use of call options in reality? Well, unlike this, which is where you buy a call option, I've shown you the payoff, the most popular use is actually to sell call options, right? So, especially in the asset class that I grew up in, which is equities. Most of the world, most of the investment universe owns equities. So they hold stocks in various companies around the world. And they're not planning on selling those stocks. They hold them for the long term, they have them in their portfolio. But what they do is they utilize the fact that they're long these stocks by selling call options on those stocks. And they do that to enhance their yield. They do that to earn some premium. Because if those call options that they receive a premium for, that they sell, if those call options go out worthless and they expire worthless, then what you've basically done is you've managed to earn a little bit of extra yield out of owning your stock. And that's basically what people do. So that's called covered call writing. and it is by far and away the largest use of call options in the market. And because of that use, you have a natural supply of upside calls. So in the options market, that's what we find, a natural supply of upside calls, which suppresses the price of upside calls in the market. And that's basically call options. Thanks so much for watching. Hope you found this video useful. If you have any questions, feel free to write them in the comments below. And to see more short and snappy video tutorials like this one, you can subscribe to my channel. For further information about my training services, please visit optionsinsight.com.